Renowned Tesla bull Cathie Wood betrayed Tesla by purchasing some stock in GM after she met GM CEO Mary Barra last year. But if the latest news on General Motors are any indication, Cathie's betrayal is going to cost her dearly. This morning, some new information has come to light that shows points of a major struggle for the automaker. These struggles could be a sign of bigger issues to come later this year and into the decade. DM's collapse is knocking on the door, and Cathie's $13 million in investment could go to zero. Renowned investment analyst Jim Cramer called this a year ago when Cathie bought GM shares for the first time. Cramer's own words: Cathie support for GM would signify a kiss of death for the company. But before we get deeper, smash that like button and subscribe. The DM is currently offering buyouts the majority of its U.S. salary workers. That is just the tip of what is lurking within the automaker company. Essentially, DM is looking to cut about $2 billion this year. And one way they're doing this is by offering employees the opportunity to leave. We've seen this. The other automakers, and it was just a week and a half ago that GM announced the elimination of about 500 salary jobs around the world. Now, the company is sending out offer letters to almost all of its salaried staff. How many people will take the buyout and whether or not this will keep the company from having to initiate broader layoffs remains to be seen. Let me walk you through what I think is going on based on GM's Q4 earnings performance. They had flat sales in North America quarter after quarter, but there was an increase in inventory buildup in the same region. This means that they sold out the same number of cars, but the dealership inventories grew. Essentially, the net sale of cars sold to customers in Q4 were less than in Q3. Even though GM recognized it as a sale in their earnings report, all they did was move inventory from their factories to the dealership network. Dealerships, particularly those selling GM, have an abundance of inventory. However, the auto industry has been slowing down since November, and things are not looking good for General Motors. The major issue here is that GM had to pause production of their best-selling truck because dealerships had too many cars in stock. This may have been portrayed as an increase in production amid steadying demand, but in reality, buying fewer cars. It's a tricky situation because DM makes the majority of its revenue from SUVs and trucks. So they're pausing production on the one thing because pickup trucks are the priciest cars available. Automakers like GM rely on selling them to turn a profit, which is bad news for Cathie and her ARC. Invest money in 2022 in a report outlining the company's recent trades. Cathie Wood's ARC Investment Management disclosed that it had purchased 158,187 shares of General Motors Gen for its autonomous technology and robotics art fund, signaling a shift from her previous criticism of traditional automakers. According to Forbes, a well-known stock picker who specializes in cutting-edge tech companies oversee over $60 billion worth of assets for her kind. In an interview with Yahoo Finance, ARC Investment Management, who had previously criticized traditional automakers, recently expressed her admiration for General Motors' advancements in autonomous driving technology, electric vehicles, and its San Francisco-based Cruise subsidiary. The interview also revealed that the company had discussed the company's electric vehicle initiatives with GM CEO Mary Barra, and that the firm was considering investing in GM while maintaining an open mind. It's hard to ignore the massive slowdowns and layoffs that are looming for companies like GM. While slowdowns are inevitable, the key question is what the next cycle will be and how it will affect car companies. In my opinion, there are two clear contenders for the next cycle: compelling EVs and affordable cars. The Fed tightening rates and people struggling to make ends meet is becoming increasingly concerning, citing GM's focus on cruise automation and Barra's efforts to turn the company around. This is a notable shift from Wood's earlier criticism of GM and Ford's electric vehicle plans and her prediction that they may go bankrupt. It should come as no surprise that Tesla was the only automaker in the US to expand annually in 2022. This shows that EVs are clearly replacing gas-powered vehicles, and the trend is just getting started. Nevertheless, there is a substantial demand for reasonably priced vehicles, especially EVs. Where is DM standing in all of this? It appears like they're in difficulty, even though there are some reasonably priced EVs on the market, such as the Chevy Bolt. But it's not without its problems. If automakers can't supply this, they risk slipping behind. GM needs to adapt and create compelling, affordable EVs if they want to stay relevant in this changing market. That has some affordable cars that could help them achieve their goal, like the Blazer EV, which starts at $45,000, and the Equinox FF, which starts at roughly $30,000. The vehicle has suffered from multiple recalls, which made it to her buyers. However, they need to ramp up production on their upcoming cars like the Lyric Blazer, Equinox, and Silverado, which are expected to be available in 2024 and 2025. As far as inexpensive EV cars go, Tesla is miles ahead of the competition. When the automaker's next affordable electric vehicle goes on sale, Elon Musk, the CEO of Tesla, plans to use it mostly for autonomous driving. While investors had anticipated more details about the car at Tesla's recent investor day, none were revealed. Nevertheless, Musk recently gave an update on the car during an interview at the Morgan Stanley conference, explaining that the company has a clear strategy to make a smaller vehicle that costs about half as much as the Model 3 and will almost exclusively operate in autonomous mode. Musk announced the development of the low-cost EV in 2020 with a target price of about $25,000. Musk stressed that Tesla needs autonomy and that the company's most notable development to date is the quick development of the fully autonomous system. During a CNBC segment last week, Jim Cramer, a well-known CNBC host and personality known for his candid opinions on people and stocks, discussed the struggling stocks of General Motors and Ford Motor Company. Cramer was hesitant to recommend investing in General Motors, citing his belief that Cathie Wood's involvement may have a negative impact. Wood recently decreased her investment in Tesla Incorporated, leading electric vehicle company, and instead purchased shares of General Motors for the first time. Although DM seems to be doing well, I'm cautious about Cathie Wood's involvement, since it may not be good for Cramer's comments that DM is doing well. I believe that Cathie Wood is the kiss of death. Jim Cramer, in a recent CNBC segment, advised investors not to buy General Motors shares during a recession, citing the need for more substantial declines. Before larger investors start buying a stock, Cramer used Warren Buffett's purchases during previous market bottoms as evidence. And these remarks came after Cramer had recently criticized Palantir Technologies, stock linked to Cathie Wood, dismissing it as a company that probably would not have gained much attention if Wood hadn't been involved in a Mad Money episode in January. Jim Cramer recommended that his audience short Cathie Wood and think about purchasing the entire Capital Short Innovation ETF, which is intended to wager against Wood's flagship stock. He attacked ARK Innovation for being the ultimate hedge fund that held traditional growth stocks and for having a drowning scene in the show. But a lot of people on social media quickly brought attention to Cramer's earlier remarks from less than a year ago, in which he called Wood a genius at the height of her ETPS performance. As legacy automakers struggle with the transition to EVs, a lack of early investment in affordable EVs may be a contributing factor. On Twitter, Bloomberg senior analyst Eric Balchunas pointed out the irony of Cramer's recommendation, noting that Wood's ETF had declined by 50 since his initial comment in February 2021. Cramer suggested that Wood should halt new investments into art funds and concentrate on improving performance. What are your thoughts on these concerns? The future GM in the EV market is unclear, and it's unclear how long their profitability will persist. Tesla, on the other hand, has made significant investments in reasonably priced EVs and could become the dominating competitor. Please feel free to offer your opinions in the space provided below and sign up. We appreciate your time, and we'll see you in the upcoming foreign video.